There are several different methodologies that an accountant can employ to create a statement of cash flows. By far the most popular is what is referred to as the indirect method. And in the indirect method, you start your statement of cash flows by adjusting your net income to your net change in cash. Well, how can net income be different than the change in your cash flow? Well, think about if you made a sale of inventory and you did so on account to your customer, and the customer has not paid you yet. Well, you would record the revenues from that sale at the time that you made the sale, which means those revenues would have found their way to your income statement and ultimately increased your net income. But you haven't been paid yet, which means you wouldn't have any cash, and it would have zero effect on the cash balance of your bank account. Inversely, imagine that you got a utility bill at the very end of the month that you didn't plan to pay until the next month. Well, at the time, you would know that you would owe it, so you would record the liability, and when you record the liability, you also record the expense. That expense would show up on your income statement. It would lower your net income, but since you haven't actually paid it yet, it wouldn't have any effect on the cash in your bank account at the time. So accounting income is the amount of net income you report on your income statement isn't always the same as your change in cash. And using this indirect method, we need to tell users of our information exactly what effect that change in net income had on our actual cash. And to do that, we are going to have to compare account balances, which means we are going to need the last two balance sheets. We're going to have a balance sheet that says this is how much the balance of our inventory, our liabilities, etc. changed during the period. And to be able to compare that, you also need the last period's numbers in addition to the current period numbers. Because we are adjusting net income to our net change in cash, we need our net income. Or are we going to find that on the current period's income statement? So the main documents that you need to prepare this are the income statement and your last two balance sheets. But if something is not obvious or present just from those two financial statements, you may need to dip into your journals and T accounts to find the necessary information to make sure that you are coming up with the correct net change in cash. Because this document will require you to have your current period income statement and your current period balance sheet at the ready, it is the last financial statement of the main ones that you produce each and every period. You guys have learned already that you start with the income statement, you go on to your equity statement, and then to the balance sheet to be prepared in that order. Well, now that we have a fourth one, the statement of cash flows, that comes at the end. So after you make your balance sheet, but before you close your entries, you are going to make your statement of cash flows. And this is the statement of cash flows in all of its glory. There's a lot of information here. Don't worry, we're going to break it down piece by piece as we go through on how you get to the end number of a statement of cash flows. But right now, I just want you to focus on presentation. We are breaking our activities down into four major classes: operating, investing, financing, and non-cash activities. Well, for the sake of comparability, to make it easier for our investors to use this information, every company prepares them in the same exact order, so they are presented in that order: operating, investing, financing, and non-cash. When I took this course, my professor told me that the best mnemonic to remember the order of putting your activities is only in fund's name, OIFN, operating, investing, financing, and non-cash. But if you can come up with another mnemonic that works for you, it's fine. Only thing that really matters is that you have them presented in the proper order. So if someone is comparing your company to another company, they can put them side by side and they look exactly the same. And on this statement, we are going to break down how each one of those subsections, operating, investing, and financing, changed our cash during the period. And we're going to use the total amount of cash either provided by or used for each of those activities to determine what our net increase or decrease in cash was for the period. If we have any significant activities which would have affected our balance sheet but did not affect our actual cash accounts, for the ease of these users of our information, we should display those at the bottom of the statement of cash flows. So as you can see here, Meta Company has the purchase of plant assets and the issuance of long-term debts down here that are non-cash and financing activities. Somebody would go and they'd look and they'd say, well, how did they acquire the plant assets that they have? Because there's a huge increase in that account on their balance sheet. I don't see it anywhere in the statement of cash flows. Well, you would find out that in this case, Meta Company got a $140,000 loan to purchase those plant assets, in addition to the $60,000 that they have above that they paid in cash as a down payment. That's how they got to the $200,000. So the purpose of the bottom section is basically to explain things that wouldn't readily be apparent just looking at the body, the top part of the statement of cash flows. Let's prepare the operating section using the indirect method. And this section is by far the hardest section of the statement of cash flows. Once you get through this, the rest of it is all downhill. And what we're going to be doing in this operating section is, again, adjusting our net income to how our normal operating activities changed our net cash position. And to do that, you start with your net income, which you're going to take directly from the income statement. So ShopMart had $40,000 in net income for the year ended December 31st, 2018. We have that listed. Now we need to adjust it. Well, what are we going to do to adjust it? We have to think about how things changed our net income that wouldn't change our cash balance. And a big part of that are your non-cash expenditures that you get to recognize on the income statement. Things like depreciation, depletion, amortization, etc. All of these items actually lower your net income, but they don't have any effect on your cash. No one goes to you and says you need to fork over $1,000 this month because your car got older. It just loses value on its own, but you paid for it in advance. So if you have any of these non-cash expenditures, to adjust your net income to its change in cash, you have to do the opposite. It reduced your net income, but it didn't reduce your cash. So to adjust to our cash change, we're going to add it back in. And ShopMart here is adding back in the depreciation expense of $20,000 that they had on their plant assets during the period. Another common item on an income statement which will affect your net income but not affect your cash are gains and losses that you have recognized. And the reason for this is these things all stem purely from the valuation you had of those assets at the time that you disposed of them. Take this instance. Say you had a piece of equipment and your book said it was worth $40,000 at the time that you're disposing of it, but you sold it for $50,000 cash. Well, you sold it for $10,000 more than the book value of that equipment, which means you would recognize a gain on the disposal of that asset of $10,000, which would ultimately increase your net income. Let's do the same run through here, but this time, let's say we used a different depreciation method and we had depreciated that equipment much more. It only had a book value of $30,000 at the time that we sold it for the same amount, $50,000 cash. Well, now we are getting $20,000 more for it than our books say it's worth. We would recognize a $20,000 gain, which would increase our net income even more than that $10,000 gain. But the problem is, even though that second instance increases our net income more, it doesn't increase our cash flow more. We're getting $50,000 cash in either instance. So gains and losses that you recognize during the period have an effect on net income, which does not also affect your cash account. And to account for that, you need to reverse it out, to do the opposite. If we had a gain on disposal of plant assets, as ShopMart did here, of $10,000, that would have increased their net income by $10,000, but it would have not increased their cash balance by an additional $10,000. So since that gain increased net income, and we are adjusting net income, let's go and reduce out that gain in our adjustments and subtract it out. So for gains and losses, do the exact opposite of how it would affect your net income. Gains always get subtracted in the operating section of a statement of cash flows, while losses always get added back in, just like all of your non-cash expenditures. And then once you are through that part, the other two account types that are going to appear in the section are your current assets and your current liabilities. And under this indirect method, we are going to adjust our net income to our net change in cash by finding how those accounts changed from the end of the prior period to the current period. So in this case, ShopMart had $42,000 worth of cash at the end of 2017, and they had $22,000 worth of cash at the end of 2018. So the balance of their cash account, or the amount of money in their bank account, decreased by $20,000 during the period. And here is the joy of a statement of cash flows. That number right there is our answer. We have to prove to users of our information what we used our cash for, what it came in by, all of those things. But in the end, we're going to come up with our net increase or decrease in cash. And that is our answer right there. So the answer, the final number that you have on your statement of cash flows, should always be equal to the difference that you've reported in your cash account on the last two balance sheets. For your other current assets, we're going to use that change in value to adjust our net income to our net cash from operating activities. ShopMart had $73,000 worth of AR at the end of 2017. It's up to $90,000 at the end of 2018. That is a $17,000 increase. The company had $145,000 worth of merchandise inventory on its books at the end of 2017. It's down to $143,000 at the end of 2018. That is a $2,000 decrease. Accounts payable took a significant jump for ShopMart, up from $50,000 last year to $90,000 during the current year. That is a $40,000 increase. And there are accrued liabilities, all the things that you would put on the books at the end of the period during your adjustments, like salaries payable, interest payable, etc. They were $10,000 at the end of 2017. They're down to $5,000 at the end of 2018. That account's value decreased by $5,000 from the prior period to the current period. And we're going to use that information in this operating section to determine what total amount of adjustments we need to make. So in this case, ShopMart is reporting its increase in accounts receivable of $17,000, its decrease in merchandise inventory of $2,000, its increase in accounts payable of $40,000, and its decrease in accrued liabilities of $5,000 to come up with a total amount of adjustments when they add those changes to the depreciation expense and the gain of $30,000. And you may be looking at this and saying some of those numbers are negative and some of those numbers are positive for the current assets and current liabilities that you just put in there. How do you know when it's going to be negative and how do you know when it's going to be positive? Well, here is your guide. When current assets increase, your cash decreases. And that seems weird because you want current assets to be a good thing, but think about it. If you have more stuff, if you have more current assets, how did you most likely acquire it? You probably paid cash to get it. So buying more stuff is going to decrease your cash account. In our example right here, we have an increase in accounts receivable, which is decreasing our cash flow by $17,000. Why would that be? Well, if our accounts receivable increased and we did assumingly the same amount of sales during a period, that means more of our customers are paying us on account and they're not actually transferring cash to us. So that increase in the amount of money that's owed to us is worse off for our cash flow. So when you have an increase in a current asset, decrease your cash flow. So let's take that increase in AR and we'll adjust our net income down by that $17,000. Next up, we have a decrease in merchandise inventory of $2,000. Well, when a current asset decreases, your cash increases. Why would that be? We're comparing how much cash we had at the end of the last period to what we had at the end of this current period. And if we had a decrease in merchandise inventory, one of two things happened. Either we sold more goods during the period, which means we should have more cash because we did more sales, or we bought less of this merchandise inventory to sell, which means if we bought less, we should have more cash. So a decrease to your current assets will increase your cash flow, and for ShopMart's $2,000 decrease, we are going to adjust our net income up $2,000. For current liabilities, they work, as I say, the same. When your current liabilities increase, your cash increases. We had an increase in accounts payable of $40,000. That increases our cash flow by $40,000. Why? Because we are paying for stuff on account. Think about it like using your credit card. If you put it on a credit card, it's not going to decrease your cash account. It's not going to decrease the value of your bank account. So now we owe more, but since we owe more, that means we transferred less cash to acquire the goods that we need. So that increase in accounts payable of $40,000 will adjust ShopMart's net income up by $40,000. And then they had a decrease in accrued liabilities. Again, liabilities means you owe something, and if we owe less of something than we did at the end of the prior period, well then we must have paid more of it off. And if we paid more of our debt off, our cash has to be going down. So when you have a decrease in current liabilities, your cash decreases because you're financing more of your debt. So ShopMart's $5,000 decrease in accrued liabilities is going to adjust their net income down by $5,000. And now that ShopMart knows that they had $40,000 of net income, but they need to adjust it up by $30,000, which is the total of all these numbers reported over here. They're going to determine the actual cash which was provided by their operating activities was going to be $70,000. So this number is just your net income adjusted for the total amount of your adjustments right here. And that is one of the three sections we have to knock out, and it's also the hardest section of the statement of cash flows. So from now on, things are going to get much easier. Moving into the investing section of a statement of cash flows, we're going to say that during the year, ShopMart purchased a piece of property for $310,000 cash, and they sold that used piece of equipment for $50,000 cash. Well, if we purchased something in cash, what happened to our cash flow? It went down. So we have a cash payment for the acquisition of this plant asset, this property, of $310,000. When you sell something to another party and are paid in cash, which we are assuming is happening here, what happens to your money in your bank account? It goes up because you're receiving the cash. So the sale of this used piece of equipment is going to be for $50,000. We should increase our cash flows by $50,000. So if we spent $310,000 to acquire the property, and we offset that a little bit by selling equipment for $50,000, then the overall change in cash that happened because of our non-current assets, our investment in the future of our company, is that it decreased our cash balance by $260,000. So for the investing section, all you need to do is think, are we the ones paying out the money, or are we the ones receiving the money? And if you're the one paying it out, you decrease your cash flow. If you're the one receiving it, you increase your cash flow. In here, let's take some examples and say that during this period, the company, ShopMart, took out a $90,000 note payable from a local bank. Well, what's going to happen here? We are signing a note, and we are getting the cash right now, which means we would have an increase to our cash flow. If we made a $10,000 payment, excuse me, if we made a $10,000 payment on those notes payable, what would happen to our balance of our cash account? Well, we're taking the money out of our account and transferring it to the bank or whatever company we owe for these notes payable, which means the money's coming out, we have to have a decrease. If we issued $120,000 worth of common stock, that means that our now owners, our shareholders, paid us to buy a portion of our company. And since they paid us, we got the money. That's going to be an increase. If we purchased $20,000 worth of treasury stock, about $20,000 of that common stock back, we had to pay the money out to them this time to repurchase that stock from them. That would decrease our cash flows. And if we paid those owners $10,000 in dividends at the end of the period, we're taking money out of the company, handing it to our shareholders, and since money's coming out of the company, that is a decrease. So all of these items will fit into the financing section because they're either long-term debt, like notes payable, or equity accounts, like common stock, treasury stock, or the withdrawal accounts you have, dividends related to your equity accounts. And to figure out if it's going to increase or decrease your cash flows, are you the one receiving money in the instance, or are you taking the money out of your company to pay it to either your creditors, your bondholders, or your shareholders? And when we throw all those numbers in here for ShopMart, we see that they took in $90,000 from issuing a notes payable. If they paid $10,000 to pay off a portion of that notes payable, if they received $120,000 from issuing common stock but paid out $20,000 to buy some of that back and another $10,000 to pay dividends on the shares that are still owned by our shareholders, then in total we had $170,000 of cash which came in from financing activities. And with that, we have our three subsections done. So to find your overall net increase or decrease in cash, all you do is you take the net cash from operating, from investing, and from financing, and you add them all together. We had $70,000 in cash flows provided from operating. We used $260,000 for investing in the future of our own company. But we brought in $170,000 from financing activities, from selling stock and taking on long-term debt. Well, if you add those three together, you come up with negative $20,000. Numbers jibe if you look at it right here, right? If we brought in $70,000 from operating and $170,000 from financing. That's $240,000 in cash that we brought in, but we used $260,000 for investing, so that wasn't enough to cover the total amount that we paid for investing. Therefore, our cash flow has to be going down. And if you remember, when we went back to the very beginning for our current asset section, we determined that our net decrease in cash was indeed $20,000. So put all together on your statement of cash flows, your net decrease in cash should always be equal to the difference between the cash account that you're reporting this period compared to last period. If your number doesn't come out to the difference that you had on your balance sheet, you got something wrong with your statement of cash flows, because we're just proving to users where our cash went. They know how much of our cash we took in because we're profitable from operations. They know how much of our cash we took in because we had to borrow it or we had to issue equity to obtain it. They know what we used cash for. Maybe we, purchased land. Maybe we paid off more of our debts. They'll know all of the things about our business, about how effective we are using our cash. But no one wants to go on a statement of cash flows and say, okay, does that $20,000 actually match the difference that you were reporting on your balance sheet, and have to go back to your balance sheet. So for the convenience of the users of our information, it's common practice to report your last two balance sheet amounts for cash right underneath your net increase or decrease in cash. And in total, that is the overall setup of ShopMart Incorporated's statement of cash flows. So just running it through one more time, you always start with your net income. You make adjustments to your net income based on any non-cash items that you report on your financial statement, namely your non-cash expenses like depreciation and any gains or losses that you experience during the period. You make adjustments for your current assets, and you make adjustments for your current liabilities. And after you find the total of all of your adjustments, you adjust your net income in that manner to determine the net cash provided by or used for operating activities. You move on to investing. Again, if you are the one paying for it, your cash has to be going down. If you're the one receiving the cash, your cash has to be going up. And the total of all of your different different changes related to your non-current assets is going to be your net cash either provided by or used for investing activities. And then for financing, same concept applies down here. If you are the ones receiving the cash, your cash flow is going to go up. If you're the one paying out the cash, your cash flow is going to go down. Find the total amount of net cash that was provided by financing activities, and the sum of your three major categories up here, operating, investing, and financing, is going to give you your net change in cash. One common mistake that I have seen quite a bit in my time here at Mohawk Valley Community College is students determining this net increase or decrease in cash by summing up everything that is in the rightmost column. Well, that $70,000 that ShopMart right here has for the net cash provided by operating activities is actually already the sum of the two numbers above it. So if you just added up everything that was above right here, you would be counting that $70,000 essentially twice. So for your net increase or decrease in cash, please remember that is only the sum of your net cash provided by or used for operating activities, and your net cash used for or provided by investing activities, and your net cash provided by or used for financing activities. And that will give you your total net increase or decrease in cash. And then you show your investors, indeed, that is the difference between the last two cash balances that we reported. We reported $42,000 to cash at the end of the 2017 year. It's down to $22,000 in cash at the end of the 2018 year. That is a net decrease of $20,000.